Let me make it clear that the banks will take care of all needs. You must not be stampeded by rumors or guesses. Let us unite in banishing fear.
We put this, our hard-earned money, in banks. And these banks hold billions, trillions in assets. We buy groceries, pay rent, fill up our cars, and we expect the money we put in the bank to still be there. Because that's what a bank does. It holds our money for us, right? But what happens when we go to get our money out, but our money's not there?
Long lines forming at branches across the country with customers scrambling to access their money.
This is everything that we have saved.
This is a story about what happens when banks fail. Why some of the largest institutions in the world that we put our trust in come crumbling down. From the Great Depression to the global financial crisis, all the way through until today. It can happen at any moment. This is a bank run.
Bank run.
Bank run.
Bank run. Bank run.
Bank run. This is rapid.
This market is as volatile as you'll ever see.
This bank was playing a very constructive role.
How did regulators miss this?
We have provided the machinery to restore our financial system, and it is up to you to support and make it work.
Okay, let's get one thing clear. When you put your money into the bank, it no longer belongs to you. That money belongs to the bank now.
Wait, what?
That might be kind of upsetting to hear.
The money that individuals and businesses put in the bank through our checking or saving accounts is actually a super low interest loan to the bank. The bank then turns around and uses our money to lend out at higher interest rates, like mortgages or business loans. Banks borrow low, lend high, and then keep the spread, their profit. So essentially, you're lending your money to the bank.
People keeping their money under their mattresses? Where should I hide it? Not looking so crazy now, are they? And that's literally what people were doing back in the 1930s during the Great Depression. Banks were failing and people were losing their savings.
I want to talk for a few minutes with the people of the United States about banking.
This is the new President of the United States, Franklin Roosevelt, trying to calm the nation as he steps into office during one of the worst financial depressions in US history.
I can assure you, my friends, that it is safer to keep your money in a reopened bank than it is to keep it under the mattress.
If you were a normal working class person during the 1930s, every day this was your fear.
You got any money in the bank? You better hurry.
A run on the bank. When lots and lots of people rush to withdraw their money all at the same time, but the bank doesn't have the cash to pay everybody. In the 1930s, it involved physically running to your local bank branch. Today, we can just move money with a click from our smartphone, which is why when Silicon Valley Bank collapsed, when customers withdrew $42 billion in only 24 hours. But let's rewind for a second and take a look at how a bank run starts. You hear a rumor.
Rumors.
Perhaps it's news about the bank's financials. Maybe someone implies that it's bad news. It's very ironic because a tweet about a potential bank run can actually cause enough panic for a real bank run to happen. Now, the tweet might be true or it might not be, but the crazy part here is that the truth doesn't really matter. Either way, it causes people to panic.
Oh my God, it's happening.
They're scared they can't withdraw their money because banks don't just put your money in a vault and keep it there for you.
Some of it is put to work for the community, in which some of the cash goes into Federal Reserve bank stock.
They use the magic of fractional reserve banking. The history of this is a whole other rabbit hole to dive into. It includes medieval Europe, early bankers, goldsmiths, the invention of paper money, ditching the gold standard. But the too long didn't read is that banks don't actually have their customers' money on hand, which is kind of mind-blowing when you discover this for the first time. Banks only keep a small fraction of the cash they owe customers, and they lend out the rest to earn interest. That's how they make their money. They normally only keep about 10% in reserve. So if 10 customers deposit $100 each, the bank should have $1,000 cash. But the bank kind of figures that probably only one person will want to withdraw their money at a time. So they loan out the other $900 of customers' deposits. House loans, business loans, stuff like that. The bank only keeps $100. $900, but they actually owe $1,000 to their customers. This is how fractional reserve banking works. And when customers come looking for the other $900 that's owed to them and it's not there, that's when a bank run happens. As George, the lovable banker from the movie It's a Wonderful Life, set during the Great Depression, finds out when there's a run on his bank, he tries to explain.
You're thinking of this place all wrong, as if I had the money back in a safe. The money's not here. Well, your money's in Joe's house, that's right next to yours, and in the Kennedy house, and Mrs. Maitland's house, and 100 others.
But bank runs get even worse. When one bank falls, it has a domino effect on all the other banks. In financial lingo, this is called contagion.
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 A bank that is perfectly healthy could go down just because it traded with a bank that had the bank run. This happened during the 2008 financial crisis. The reason it was so devastating is because the financial contagion spread to almost every bank in the world, causing the global financial meltdown.
There are fears the sell-off will continue on Wall Street.
I think this is the most significant financial crisis in the post-war period.
The collapse of Bear Stearns was catastrophic.
Definitely a very, very difficult time, and it's not going to get better quickly.
When these banks fail, what happens to the customers? Normal people keeping their money in the bank. Do they get the money that they're owed? I mean, they didn't do anything wrong.
Where's my fucking money? Where is it?
During the 1930s Great Depression, more than 9,000 banks failed. Normal people lost $7 billion in deposits, around $130 billion in today's dollars, and they didn't get their money back. But to stop this kind of widespread bank run from happening again, the US government set up the Federal Deposit Insurance Corporation, or the FDIC. They insure depositors up to $250,000 per account per bank. So today, if your bank goes bust, the US government will pay you back up to $250,000. And most other countries have their own versions of this, insured up to various amounts. Since 2001, there's been more than 562 bank failures in the US. The third biggest bank failure in US history just happened. And 3 days later, the second biggest bank failure, $209 billion. In the case of Silicon Valley Bank, the FDIC stepped in to guarantee the money of all the depositors, even above $250,000. The customers were saved, and the bank died.
I don't want to go. I don't want to go, sir, please.
Bank failures aren't going away anytime soon. And you'll notice that these bank failures are only getting bigger and bigger. This is because now you're able to withdraw cash from a bank with a single click and tell millions of others via a tweet. Bank runs can happen more quickly and more severely than ever. I'm not telling you this to be gloomy or to be an alarmist, but just to try and shed some light on how our complex financial system actually works. Economists and policymakers, they're the ones talking about this finance stuff behind closed doors, but we're the ones who get affected. So when things get crazier in the future, and unfortunately they most likely will, we'll just be a little bit more informed. To me, it seems like our fractional reserve banking model, which was invented in medieval times, is more fragile than ever in our digital age. So what do? Keep our money under a mattress?
Hid under a bed.
Governments have a very strong incentive to keep the banking system working, to stop social unrest and the whole thing from breaking down. So they help out when there's a bank failure, as we just saw, and they ideally prevent them entirely. All of this is just a reminder for us to think a little bit more deeply about our money, where we put it, and what we invest in. Just trying stuff.